If gold has topped, corrects to a shallow 23.6% retracement, we would see gold go to 2635 and then move back up to a top of about $2,765. If it is a deeper correction to $2,590, we would expect the fifth wave to have the same price move in terms of distance, but only reach just above 2,700 at 2,723, 2725. And that would conclude the impulse phase.
In the ever-volatile precious metals market, gold has been making headlines with its recent price movements. Renowned market analyst Gary Wagner, known for his technical analysis expertise in gold and silver markets, suggests two potential scenarios for gold's price movement. First, he projects that if gold experiences a shallow correction to the 23.6% Fibonacci retracement level at $2,635, it could rise to around $2,765. Recent market action appears to support Wagner's outlook. After 2 days of declines, gold surged above $2,640 per ounce, driven primarily by escalating geopolitical tensions in the Middle East. This surge pushed gold futures past the critical $2,640 resistance level, indicating a potential breakout with a medium-term target of nearly $2,800. In the case of a deeper correction to $2,590, Wagner anticipates gold reaching between $2,723 and $2,725 during what he terms the fifth wave of the price movement. The timing of these movements is particularly significant, as market volatility is expected to increase in anticipation of next week's Federal Reserve announcement. Analysts suggest a weekly close above $2,650 would further align with Wagner's bullish scenario, potentially signaling additional upward momentum. As of the mid-American trading session, gold was trading around $2,635, precisely at Wagner's projected 23.6% Fibonacci retracement level. This alignment lends credence to his analysis and suggests that the market follows the patterns he has identified. Despite a mixed market mood and recent declines, gold has managed to maintain its position above Wagner's critical retracement level. Before diving into the video, subscribe to our channel and hit the bell icon so you never miss an update. Also, feel free to share this video with anyone who might benefit from it.
Well, we are looking at a chart in which I'm going to present the models of one likely scenario. And what we are doing here, this is my master chart with my full Elliot Wave count, Fibonacci extensions, and Fibonacci retracements. So what we do is we measure the distance gold move from the bottom or end of this correction up to the recent top, what we are labeling as a primary third wave. And so we moved from roughly, call it 2,400 up to $2,700. And then we look at different levels that it could correct to. And what we're doing is looking at a Fibonacci retracement, and the shallowest retracement would be a 23.6, and that would take gold down to $2,635. A deeper correction would be a 38.2% extension, taking gold just below 2,600 to 2,590. The reason that I believe it will be a shallow correction is the typical model in Elliot Wave. There's a 5-wave sequence called the impulse phase, in which waves 1, 3, and 5 move in the primary trend direction, which of course has been up, and waves 2 and 4 are corrective waves. And on a corrective wave, we look for one to be an extremely deep correction beyond a 61% retracement, and the other one to be a shallow correction. And so when we look at this wave 1, which took gold from roughly 2360 up to 2530, the correction itself came in just below the 78% retracement. And that's what this line here represents. And you do have some wicks that come in there, meaning the tails or the intraday low. And so if we've had a deep correction, the most plausible model would suggest a more shallow correction. So if we are correct and gold truly corrects from here rather than it being a one and done, or in the case of current analysis, two and done, because we had a sell-off on Friday and follow through today, we could see gold trade as low as $26.35 and as low as $2,590. From there, we would go into a final fifth wave. And in Elliot Wave modeling, one of the simplest formulas to follow for a fifth wave is that wave 1 and wave 5 have the same price move. In other words, if wave 1 was a gain of $200, we would expect the gain of the fifth wave to be $200. So that's all I'm doing is basically modeling the price move here and extending it. If gold has topped, corrects to a shallow 23.6% retracement, we would see gold go to 26.35 and then move back up to a top of about $2,765. If it is a deeper correction to $2,590, we would expect the fifth wave to have the same price move in terms of distance, but only reach just above 2,700 at 2,723, 27.25. Yeah. And that would conclude the impulse phase.
However, Wagner's analysis doesn't stop at price levels. He examines the moving average convergence-divergence indicator, which suggests that gold is potentially overbought. This scenario prompts him to look for signs of a price correction. The analysis aligns with the broader technical picture of gold's current market position, with gold appearing poised for some profit-taking level. Further supporting this view is the Relative Strength Index, which has surpassed the 70 mark on higher time frames. Historically, when this occurs, we often see a period of consolidation or selling pressure to ease those overbought conditions. However, Wagner cautions that while the RSI might suggest a correction is due, it's not an automatic sell signal. Gold remains in a solid uptrend, making it difficult to gauge how far it could rise before any significant pullback. Wagner employs a daily candlestick chart, featuring a stochastic oscillator to assess the current price relative to recent highs and lows. Peaks above 80 suggest the price is at a maximum, prompting Wagner to watch for the blue line crossing below the orange line as a potential correction signal. Let's get back to the interview.
Well, I absolutely think that this is an opportunity for traders to bank profits. The move has been phenomenal. What we are looking at on this first chart is a daily candlestick chart of the continuous contract of gold futures. And what we've identified is a simple pattern called a tower top. And what you look for in a tower top is after you get a sizable rally, you start to get a couple of equal highs as well as closes. This green candle here, the top represents the close. It's identical to the opening price on the following day. And that's when we saw that there was a likelihood that we could be seeing gold correct. Also, on the bottom third of the screen on this chart is the MACD, the moving average convergence divergence. And you can see that it is over a level that we look at as potentially overbought. And so this is when we would look for potential signs that gold is correcting. The next chart that we'll simply look at, and let me go ahead and pull that up, is also a daily candlestick chart of gold. The difference is on the bottom third, I have a stochastic oscillator. Stochastics are something that have been used by technical traders for as long as I've been a technical analyst. And simply what it does is it compares current pricing to the highest high or the lowest low over a period of days. So in the case, you've got two lines. One represents current price in relationship to the highest highs or lowest lows. And these peaks above 80 are when current pricing is very close to the highest highs over the period that we're looking at. And then what we look for is this blue line to cross below the orange line. The other line is basically an average, a moving average of the first line, percent K and percent D. But to simplify it, we look for it to in an overbought scenario, go over 80, which is what this line represents here. And then we look for a cross as an indication. Now, I put an arrow up to other occasions in which it really peaked and crossed. And you can see if we look up to the top, that was a good signal that a correction followed. The second example, that occurred in the middle of July, the same thing. In other words, the stochastic oscillators both move above 80, and then you get a cross from the blue line crossing under the orange line, and you can see that prices went down. Also here, we've basically got some channel lines, which really illustrates the rally that came in and how nicely it kind of unfolded. In other words, recently we had what I'm calling a near parabolic move. In other words, we had almost a straight linear line up to Friday's intraday high just above $2,700. I am labeling major support at about $2,610, and resistance is just above 2,700. And that, of course, is based on the high that came in last week. In the case of right now, it would be Thursday's intraday high and Friday's move. So I think that what we're seeing in these first two charts is the setup or early warning signs that we could, in fact, be on the precipice of some sort of price correction.
Gold's current market conditions suggest a potential for profit-taking, supported by several technical indicators pointing to overbought levels. Historical trends indicate that consolidation or selling pressure typically ensues when prices rise. However, despite these signals, gold maintains a strong uptrend, making it challenging to predict the magnitude of any upcoming pullback. Do you think we're heading for a correction, or will the uptrend continue? Thank you for watching. If you found this analysis helpful, please give us a thumbs up and subscribe for more insights. Let us know your views in the comments below.